Hi, this is Charles Kelly, Money Tips. Is now the time to get fixed up? Now, I'm not talking about Valentine's Day, which is next week. I'm talking about your mortgages. And by the way, if you like this stuff, if you find it useful, please like and subscribe and share it with your friends so I can get this free content out to as many people as possible. Now, central banks around the world are raising interest rates. Now, we haven't heard from America yet, but the chances are they're going to raise their rates sooner rather than later. But a lot of banks around the world, including the UK, have raised rates. And that means that it will affect borrowers. It will affect mortgage rates, obviously. So mortgage rates are going up for millions of borrowers. Now, if you've got a long-term fixed rate like 10, 20, 15-year loans, or even 30 years as they get in America, then obviously you haven't got anything to worry about unless you want to move in the next few years. But you are safe. You've won the prize for sensible financial planning. Now, a lot of people in America have 30-year fixed rates, some of them as low as like 3%. So they're sitting pretty at the moment, unless they want to move in a year or two. But for a lot of people are not in that position, and particularly in the UK. Roughly a quarter of borrowers, something like 2 million borrowers in the UK, are still on what's called a variable rate, which means it can go up or down. It's just a standard variable rate, which is probably the worst rate you can be on. Or they're on a tracker rate, which tracks their so-called variable rates. Now, variable rates used to be directly linked to the Bank of England base rates, but they're not now. So they make up their own variable rate, which is usually the highest rate. Now, to get a mortgage on a variable rate, you don't usually pay any fees and that sort of thing. It's just a low cost in terms of fees, but the rates are higher. And a lot of people have had a fixed rate or a discount rate in the past, and that has expired, and they're automatically switched on to a variable rate. And some people have not bothered to change it, or they've been on a tracker rate and they've been doing very well during low interest rate periods, or a discount rate and been doing very well during the last few years. But now I think that is about to change. So I think you could be facing a substantial rise. And also those people who are on short-term fixed rates now could be in for a nasty shock when those rates expire. Most people in the UK are on short-term fixed rates, 2 years, 3 years, 5 years, maybe 7 years. Very few are on 10 or more. And that there's not many lenders out there offering very long-term fixed rates. I think people in the UK tend to move every 5 to 7 years, so they don't want to be tied up with a 30-year deal. I certainly wouldn't. But a lot of people are going to be affected by this as they come out of these rates. So, and what usually happens, at that point when you come out of it, then you're normally hit with an increase, or you have to then fix again or refinance somewhere else, and the rates will be different. They're going to be going up. And in addition to that, the lender will whack on a nice £2,000 to £5,000 fee just for giving you the rate. How they get away with this, I just don't know. They charge you to have a mortgage with them, and then you pay all this interest over the years, and they charge you this fixed rate fee. Then they charge you if you leave early, which can be quite high, and then they charge you at the end a mortgage redemption fee. Now, they used to put this up as an excuse for the deed handling fee, like £50 to post the deeds back to you. But there's not even an old-fashioned deed anymore. Most of the deeds are electronic at land registry, so it's just a flick of a few switches. But they charge you, now it's something like £150, £200, just to end your mortgage. It's just a joke, really, but they do get away with it. Now, I know that rates are going up. The UK's put up their rates by 0.25% just over a week ago, and I reported that last week. We're now on 0.5%, still very low. And as I said, the US Federal Reserve are likely to put up their rates sooner because their inflation is now 7.5%. And their inflation rate has not been seen since the early 80s when we had soaring inflation. So I think they've got to do something there, and inflation is running away. Even the boss of Tesco's this week, John Allan, said the worst is yet to come. We know that food prices have been rocketing in the UK, and he's saying they're going up even more. Now, the old Marmite thing, you love it or you hate it. Well, if you're a Marmite lover, then that's a product you need to start stocking up with, because the makers of Marmite have said that they'll definitely put in prices up. because of rising costs of all the raw materials, fuel, petrol, all these things are going to affect food. But the thing to watch if you're a borrower is definitely get your rates sorted out. You might need to talk to an advisor, your financial advisor or a mortgage broker. If you're going to switch, like if you're in a fixed rate now and it's going to expire, say, in a year's time, you could switch out of it now. You don't have to wait until it expires. Now, you might pay a redemption penalty to come out of that deal, but on the other hand, you could get a much cheaper deal now than you might be able to get in 6 months, 12 months' time. That's something you've got to discuss with your advisor. Now, the redemption penalty might be very high, as it isn't. I've had mortgages with huge redemption penalties, like 15 grand redemption penalty just to come out of it, and even more. Some redemption penalties could be low. They could be 500, they could be 1,000 or 2,000, and it might still be worth fixing up into a long-term fixed rate and paying that redemption penalty, which you can usually add on to the loan if you want to pay interest on it, that is. So that's something you've got to discuss, I think, with your advisor, and then just watch the fees. Now, talking about property, during the pandemic, we saw a lot of people leave the city centres and go and work from home, and rents in the cities actually fell. They dropped, especially in places like central London, where rents on flats actually fell and people were moving out. Landlords had empty flats and that sort of thing, and prices fell of those flats as well. But now people are coming back into the cities as offices reopen. The UK have dropped most of the restrictions, and I think all of the restrictions are going to end in the next few weeks, unlike some countries. But this means that people are coming back, and offices are saying, no, we need you back to work. Unless you're a civil servant, of course, or a government worker, then you can have a permanent holiday almost and stay working from home, but we can't get hold of you. Nevertheless, most people are coming back to the office, and you can see some normality coming back into city life. Thank goodness the restaurants, coffee places, pubs, shops are doing well again. The trains are starting to fill up again. So it's looking better than it was even a few months ago. But I think companies now say, look, you've had your time at home, doing your washing, looking after your kids. Now we want you back in the office where we can not only just to keep an eye on you, but help to motivate you and keep control of what's going on in the workforce. So Zoopla reported that the cost of renting a property in the city, on average has gone up by around about £62 a month. It doesn't sound a lot, but in some city centres that might be an extra 10%. In London it might be nothing. But nevertheless, that is happening now, and that's a sign of the times that people are going back to work. Now, other thing you need to look at the moment, this time of year, not just sort of Valentine's Day, but we're approaching the end of the tax year. The tax year in the UK, I think a lot of countries April to April, but from the UK it runs from the 6th of April to the 5th of April the following year. Don't tell me, I don't know why, it's so confusing when you're doing your tax returns and you have to think, was that 21 to 22 or was that 20? I don't know why they don't do it, from the 1st of January to the end of December, like you can for company accounts, but that's the way it is. Now, in that year, it's up to you to make tax savings. And how you can do this is something you might need to talk with your advisor or accountant. But two of the most common ways are to put money into an ISA, an individual savings account, which is a tax-free savings account. It's wrapped up in this wrapper. Now, yes, I know that interest on all accounts is low, and for most people don't pay tax on interest. But by putting money into an ISA, you are protecting it against future tax and future tax rising. And also within an ISA, you can invest into stocks and shares as well as just putting it into a deposit account. Now, if you put it into a deposit or interest-bearing account, your money and capital is safe, but the rates will be low. If you want a better return, then the advisor might say to you, well, put it into a stocks and shares ISA, and then you'll be investing in stocks and shares. Now, I wouldn't put my whole allowance into stocks and shares right now, but if you're saving a monthly amount, a few £100s a month, then that's fine, because you can benefit from the ups and downs, or what's called pound cost averaging, of buying units in the fund at decreasing and increasing prices. It might sound a bit complicated, but talk to your advisor about this. But at the moment, you can put up to 20,000 into an ISA in the UK every tax year, as well as maintaining, maximising pension contributions. Now 20,000 is quite a lot. You think over 10 years you'd be able to tuck away 200,000 into an ISA, always tax-free. So you could be drawing income from that tax-free, unlike a pension where you get tax relief on the money you put in, but you start paying tax when you're drawing your pension. But it's still important to look at both, and most people are totally underfunded in terms of pensions and savings. We saw this during the pandemic, that people couldn't survive more than a couple of months if they'd lost their jobs and they needed government help. And a lot of people work for 40 years and they get into their 60s and they are broke. I'm saying a lot of people, more like 4/5 of people end up not being able to retire or living in poverty in retirement. Only about 5% end up really rich and financially free. So you've got to look at that. You've got to look at your pensions, and now's the time to see if you can maximise your pension contribution, and that will save you a bit of tax in this year. There are other forms of tax-free savings which are a bit more complicated, a bit more specialist, and this is where you're investing into enterprise investment schemes, venture capital trusts, where you can get tax relief on the money you put in, and it's capital gains free as well. And this is to encourage investors to invest in startups and new businesses. But I'll put a link up there, you can have a look at that. But these are not risk-free investments. They carry a high degree of risk, and they're only for people that can afford to lose money as well, and people, perhaps high net worth investors. So that's a bit about what's going on. The markets are still hovering around, treading water really. They're going down a bit, then coming up a bit. As I'm speaking today, the New York exchanges are slightly down. The UK FT 100 index is slightly up, but they're definitely down on their highs of last year. And I still personally feel we are in for a bit of a crash this year, or certainly a large correction in the stock market, because of, well, A, all the money that's been printed over the last few years has been pumped into the market artificially. B, because stocks have been overpriced for a number of years, and certainly way overpriced in terms of PE ratios and real valuation, in terms of real earnings. There's been some ludicrous stock market launches in the US recently, where companies that only formed a few years ago have made no money are suddenly valued at 20 billion or 100 billion. It's just crazy. And then they come back down to reality later on. And then of course we've got the high tech stocks that have also got ludicrous valuations, just based on possible future earnings, potential future earnings. And one of those, I think, is Tesla. So just watch out for that. And that's why I think the market is in for a big adjustment. So if I was 100%, my pension fund was, which is not 100% in shares, I'd be looking to adjust that and pull back and take a more defensive view. Because, bear in mind, look, when did the last market crash happen? 2008, right? And then it would have carried on had not the government at that time did this quantitative easing to pump the market up again. So there should have been a major crash after that. There should have been a long dip in the market, but it's been artificially held up. It's been given, it's almost on life support, resuscitation, and then a life support machine. So but even so, every 10 to 15 years, we always have a correction, and we're definitely due for one now. 2008, it's a long time since there was a proper correction. So I think it's come in after 12 years of rising stock market prices, a bull market. We've had a few little dips along the way, and the same applies, in my opinion, to property. But that doesn't mean I'm saying go out and sell everything and go into cash. You've got to take your own view on that. You've got to see your own advisors, because I'm not your financial advisor. As I said, if you like all this stuff and you like listening to me, please do like and share and subscribe if you're watching this on say, YouTube. Now, I want to help you get control of your finances, unless you are already in control, in 2022. We know how people who are millionaires and billionaires, and we know the habits and traits of those people and how they invest, as success leaves tracks. And all you need to do is follow the wealthy people in order to become financially free yourself. It's not as difficult as you think, And I can show you some very simple basic steps to help you get your finances under control. Now, you might be one of these people who's already in control, but believe me, millions of people are not. And that's why most people end up at 65, either broke or 6 feet under. But most people are not going to be comfortable in retirement, especially as we see the abolition of the proper pension schemes, the final salary schemes, the defined benefit schemes. Most people are not saving enough. And this is not just about saving, it's about becoming financially free and using other tools such as leverage, such as borrowing money, such as investing, not just saving into account, but actually investing to make your money grow. So if you'd like to learn more about that, investing, managing your money, becoming a professional property investor, for instance, or you'd just like to be financially free without working any harder, click on the link below and look at my free on-demand training, absolutely free. No obligation to do anything, and I'm going to give you a special free gift if you do that, just for clicking on that. So click on the link below, I'll put that there, and I will see you next week again, unless there's an emergency update for any reason. But take care out there and have a great week. This is Charles Kelly bringing you money tips to help you save, earn, invest, accumulate, and enjoy more money. Please click on the link for the free training. Thanks and bye for now.